Welcome, everybody. This is Steve Gorin with my second quarter newsletter. The topic today, partnership audit rules, trust owning business entities after tax reform, how using a business entity can help defray investment management fees. Before I get into the details, just wanted to mention that the program is CLE certified and CLE certificates will be sent once we verify attendance. If you're seeking CLE for the webinar, you need to verify your attendance. During the webinar, 3 code words will appear. When the codes appear, please write them down, as you will need to provide them in the verification form included in the login instructions that we sent you. All CLE questions go to cle-tc@thompsoncoburn.com. We're going to talk about how the new partnership audit rules work, whether a benefit or a burden, and issues to consider when drafting partnership sale agreements or operating agreements. And I'll take about half an hour to discuss those points. We're going to talk about trust holding business interests, why you might want to use trust to hold business interests, how that can save income tax because of the 20% deduction and because of issues specific to 2017 tax reform. And we'll talk about additional income tax issues that arise using trust to hold business interests. We will talk about investment management fees. So investment management fees are not deductible for the next 7 years under the 2017 tax reform. And we're going to talk about how a family was able to save taxes by the way it's structured in investment management. And we'll also talk about how to use business entities to save tax on investments even if you can't quite get to do what that family did. We're going to talk about the partnership audit rules. So the partnership audit rules, I'm going to talk about procedures that you would use if you cannot or do not elect out, and then we'll get into how to elect out and whether you qualify or not, and about planning in light of the available choices. So again, these new partnership audit rules apply to tax returns for years beginning on or after January 1st, 2018. So you're not going to see the impact of the rules quite yet because we're going to have 2018 tax returns that would be audited. So obviously those are not going to be filed until next spring, and then they won't get audited instantaneously. So we do have some time to kind of adjust to these. And what I really want to do is give you an idea of what the framework is so you can kind of get a big picture, and then we'll talk about whether you actually ought to be changing your operating agreements for your LLCs or partnership or other partnership agreements. So the procedures, if you do not elect out of these new procedures, or if you don't qualify to elect out, here are the procedures. So first of all, if you find there's a mistake on the partnership return, then you need to file an administrative adjustment request. And that's a little bit different procedure than before. Before, you simply do an amended return and you give the K-1s out to the partners. Now you would need to do an administrative adjustment request. And fortunately, what they would let you do is you just go ahead and file it almost as if it were an amended return. But there is a little bit more formality in terms of getting it into the IRS system for potential heightened level of review. So let's suppose you think you did everything right, and you don't have to amend your return. You don't have to do that administrative adjustment request, and then the IRS audits. So what happens is the IRS will first go through the audit, figure out what adjustment it believes needs to be made. And once the adjustments have been figured out and you've kind of gotten figured out whether you're going to go ahead and accept what the IRS has said or not, the IRS is going to send a notice of proposed adjustment. And The notice of proposed adjustment will say what the various tax attributes are or from the return that need to be changed. So there might be more income, a disallowed deduction, a disallowed credit, whatever it is. Now, the language here in the statute has changed some. When this got enacted back in 2015, initially it only talked about things that increase tax. And they changed it with the appropriations law that got passed in March. And the appropriations law has now basically said that any items can be changed and they can go up or down or whatever. And so the scope of this is more common sense, the way one would think, that you can have, up or down adjustments. So you get the notice of proposed adjustment, okay, and so let's suppose it's some just immaterial amount and you're kind of like, you know what, let's just go and pay the tax. So if you want to do that, then you'd be skipping to the bottom and the partnership would just pay the tax and move on, and there's nothing fancy to do. But you might not want to pay the tax at the partnership level because that tax is imposed at the top the top rate for those partners. So actually the top individual rate is what it would normally be. So you take the top individual rate and you would apply that to the type of income and the partnership would pay that tax. Well, that might not be that great a deal. For example, you might have a partner in a lower bracket. You might have a tax-exempt partner who doesn't pay any tax. You might have partners who have losses against which they might be able to offset this adjustment. Like they might have some kind of losses that got suspended and having this adjustment increases the income, but it allows them to use it. So an example for that would be passive losses. So they may have some passive losses that got suspended because Code Section 469 did not allow them to take it, and maybe when you have a positive adjustment here on the partnership, the partner might get passive income from that, and so rather than having to pay tax now, it would simply free up those suspended passive losses and let them get applied to the passive income. So there might not be any tax. Another example might be you might have a partner who has a huge capital loss carry forward, and the adjustment might be to increase capital gain. So in those cases, we would really like to apply the partnership's tax attributes, and we're going to talk about that too. And so anyway, so we'll talk about applying partners' tax attributes, and then once you apply the partner's tax attributes and talk to the IRS about it, then the IRS will issue a notice of final adjustment. Then that will say what's done at the partnership level, and then the partnership has a choice. It can push out those items to the partners, and then they have to pay the tax, or the partnership can just pay the tax. And we're going to go through all of these different procedures here. So some key terms as we go through this. The first one is the partnership representative. Now, under the TEFRA rules that used to apply, you would have the tax matters partner. And the tax matters partner had a lot of duties. The partners may have had some ability to contest what the tax matters partner was doing. And so the IRS couldn't always totally rely on what this tax matters partner is doing. And there was even some uncertainty as to who the tax matters partner was. Well, now you've got the partnership representative. That partnership representative has to be designated on your partnership return, or the IRS can just appoint one for you. And in fact, you can't even change your partnership representative from the time you did your return until the time you get audited. So only if you get audited would you be allowed to change the partnership representative. So the partnership representative, basically, as far as the IRS is concerned, the partnership representative has the power of a dictator in a banana republic. And whatever the partnership representative says, that just binds all the partners. As a matter of tax law, it binds those partners. Now, the partners could go back and potentially sue the partnership representative for what they did. The partnership representative might be violating the terms of the operating agreement, partnership agreement, whatever, but the IRS is allowed to rely on whatever the partnership representative does. So be very careful on who you're choosing. Now, in a lot of family-owned businesses, it's kind of a no-brainer who the person is going to be. Normally, it's going to be like the manager of the LLC. Whoever is doing the administrative work, they're just going to be in charge of the partnership audit. When you get into some other deals, like you might have a general partner who has a lot of different deals going on, and that general partner may be concerned about how the tax result in this deal might set a precedent for the other deals that general partner is involved in. So in that case, there might be a potential conflict of interest there. So then you might want to be a little bit more careful on who it is and maybe build in more procedures there. But for most people, it's going to be kind of obvious who that person is going to be. So the partnership representative, again, that's our dictator. So the reviewed year is the year that is being audited. So let's suppose you have a 2018 return that gets audited in 2020. Okay, 2018 is the reviewed year. And then suppose in 2020 we have the audit conducted, and then the results of that audit are going to be implemented in 2020. So 2020 is the adjustment year. So 2018 was the tax year that's affected. The 2020 is the year that we're implementing these changes, the adjustment year. I mentioned that instead of amended returns, we have this administrative adjustment request. So the partners do have a duty of consistency. So when the partnership files its administrative adjustment request, the partners are required to amend their returns to make it consistent. So the other thing is that the partnership is going to need to account for those adjustments. And so you may have, like, for example, if you have additional income, then does that affect your capital accounts in some way? Does that affect tax distributions that you make? So those are all some issues to consider. And my materials go into it. And by the way, I don't know. Oh yes. So this is following my newsletter, of course. So I'm used to doing when a lot of times in my webinars, my materials cross-reference you to the part of my materials. What you should have downloaded is my first quarter 2018 webinar. Newsletter. My 2018 newsletter goes through in writing all the things that I'm telling you orally, and you will see in my newsletter the cross-reference to the technical support and the elaboration on that. Let's suppose that we don't have an amended return, or maybe we did, and we did the administrative adjustment request. Now the IRS comes and audits the return and views that there are some things that need to be adjusted. So the IRS issues a report called the Notice of Proposed Adjustment, and it says things like, I'm going to disallow these meals, I'm going to make you report this extra income. So it tells you what those are going to be, and it issues that to the partnership, specifically to the partnership representative. Now, by the way, if you get audited the IRS needs to send the notice to the partnership representative and to the partnership itself. So if, for example, the partnership representative is somebody who got fired between the time the return got filed and the time of the audit, then the IRS does send it to the partnership representative, to the fired partnership representative at his last known address, and hopefully that's not a big deal that that person receives it. But the partnership will receive will get contacted by the IRS to begin with for the examination, and when they get contacted by the IRS for the examination, then they can say, oh, that person is no longer with us. We have a substitute partnership representative that you're supposed to use. So at that point, then you'd be appointing a new partnership representative who would be negotiating with the IRS on this audit. So the partnership representative gets these proposed adjustments and then kind of figures out, is this something that would just be easy to the partnership should just pay it and make it go away, or should we do things to try to apply the different partner attributes like I was saying before? There are two different ways to be able to apply the tax attributes. One way is that the reviewed year partner can amend that person's return. And so they do their return, they do that amendment, and then those items get taken out of the partnership responsibility. So the partnership has responsibility for 100% of the items. Suppose that a 10% partner amends his return and takes into account all those items. So now that those 10% of those items, those are taken into account by that partner, and so now the partnership just has to take into account 90% of the items. So for example, let's say that you had a partnership and 90% of the partners were in the top tax brackets and they didn't have any great tax attributes to take into account. And let's say that 10% did have tax attributes to take into account. Well, what you can do is that 10% partner can amend his return and take into account his tax attributes, and then the partnership can just pay the tax on the remaining 90%. And that way, only the person who wanted to use tax attributes has to go to any hassle, and then the partnership would just pay the tax for the rest of it. Now think about what you're going to have to do, though, in terms of people's capital accounts, etc. So if the partnership is paying the tax on behalf of those 90% of the partners, then their capital account should be hit with that 90%. And the 10% partner who accounted for his item separately, his capital account should not be affected at all by the audit. It's only the people on whose behalf the partnership had to pay the tax who would have to have be affected by the payment of the tax. Now, of course, the audit might also affect your tax basis. It might affect some of your capital account accounting, and of course that applies regardless. But in terms of paying the tax, the idea to get across is that we need to just have those 90% partners have to pay that tax. And so it would be good for a partnership agreement to have some mechanisms so that only those 90% get hit with that payment of tax. Okay, another option would be the reviewed year partner might provide proof of the tax attributes. So suppose it's really complicated to amend that person's partnership return. So then maybe the partner might produce his return and say, here's an approach I would like to take. Here's how it should affect me generally. Let's just take that approach. That approach will do rough justice, and it won't cause me to amend my return. Now, there are other reasons why you might want to do that, okay? If the partner amends the partnership's federal return, then the state will automatically get notified, and they will have to amend all of their relevant state returns. On the other hand, if you're just providing proof of the tax attributes to the IRS, then you don't have an amended return that you have to show to the state. Now, it could be that the states will work out procedures that will require some kind of notification. And in fact, the states do have an effort underway to try to produce some model statutes so that the states can take the changes to the audit rules and use those at the state level and get notified of all the changes that get made. So I'd say that right now the states are a little bit behind, and that's because we're all behind. We have some final regs, some proposed regs. We don't really know how it's going to work, and when the states develop a model statute, they're not going to want to develop a model statute and then the IRS tweaks the rules some more, and they go back and change their statute, and the IRS tweaks it again, and they go back and change it. They're going to want to get it all done in one fell swoop to the extent possible. So the states are working on it, but we just don't know how this is going to apply at the state level. But for now, the idea is, again, the reviewed year partner might be able to provide proof of the tax attributes, and then the partnership representative would take this proof of the tax attributes and send it to the IRS within that 270-day window, and then the IRS would accept those tax attributes or not accept it, depending on what the IRS thinks is fair. So you might want to actually provide this to the IRS sooner than the 270-day window, to just kind of as a rough draft to kind of see whether the IRS agrees that you provided everything that's required. But in any event, it is up to the partnership representative to gather all of the amended returns, or all, and by the way, proof that any tax that was due on the amended return got paid. So amended return, proof of payment, and if you're not going the amended return route, gather the proof of the tax attributes. So the partnership representative has to gather all of that and provide a nice, tidy package to the IRS. So you can see that what's happened here is that the government has taken the burden from the IRS auditors and put the burden onto the taxpayer, to the partnership representative, to show all of this. So that's to make it easier for the IRS to audit returns. That's because only a tiny, 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 tiny fraction of the partnership returns are being audited, and Congress wanted to provide more audit coverage. So this is how it chose to do it. So I talked about the amended returns there, and now there's really two different types of adjustments you might have. They may be just disallowed expenses or whatever, but there's also possibly there may be reallocations. So the amended returns are really the only good way to handle a reallocation, where the partner who gets hit with the extra income would amend the return, and the partner who gets the extra deduction gets to amend the return. Otherwise, the partnership would just pay the tax on the higher amount, and there would be no benefit for the reduction. So you're going to want to do amended returns for the reallocations. So consider in the form provisions the partnership representative notifying partners of their share of items in the proposed adjustment. The partners then notify the partnership representative of any amended returns for the reviewed years. The partners notify the partnership representative of any tax attributes to consider. So that's the process I would envision. I envision a flexible process. Now, there are some people who say, don't go through any of this and just do what's called a push-out election, which I'm going to get to in a moment. If the amended returns take the full responsibility for all of the tax attributes, then there may not be a notice of final adjustment. There might be a 0. But the partnership would have to pay the tax unless it decides to push out. The partnership representative is allowed to push out those items to the reviewed year partners. So in my example, the 2018 return that gets audited 2020, the 2018 partners would receive these items, and then the 2018 partners would include these on their 2020 tax returns. And what they would do is they would compute their 2020 tax with and without these items. You figure out what the additional tax is, and then then those partners will pay tax plus interest back to when the 2018 tax was due. So they pay interest back to, for example, April 15, 2019, and they pay it at a higher rate too. So to the extent you don't push out, the partnership does pay the tax at the highest applicable rate, and they count only, again, items that increase tax. Provisions in the partnership agreement might provide whether the partnership representative must, may, or may not do a push-out election. I would tend to suggest just giving the partnership representative discretion throughout the whole process, and just to work with the partners. Now, there may be times when you don't want to do that, but that would be the most flexible approach. You need to consider in the partnership agreement impact on the partnership capital accounts if the partnership pays the tax, as I mentioned before with my 90-10 example. You need to think about who bears the cost of the audit and whether there's a partner requirement to contribute cash for the cost of the audit or just to pay the tax. If the partnership has to pay tax due to the audit and we don't want to do the push-out election, we don't want to do amended returns, maybe the partnership be required to contribute cash. So we're going to talk about the electing out, whether you're eligible, how to elect out, and whether to elect out. First of all, you're eligible to elect out only if there would be 100 or fewer statements issued. So a statement means a K-1, but it really means the number of people who get affected by the audit. I'm going to discuss that in just a moment. So each of the partners must be an individual, a C corporation, a foreign entity that would be a C corporation for domestic, an S corporation, or an estate of a deceased partner. A partnership is not an eligible partner. A trust is not an eligible partner. Even if it's a revocable trust, it's not an eligible partner. So even if you're using the grantor Social Security number, it is not an eligible partner. A foreign entity that is not an eligible foreign entity is not an eligible partner. A disregarded entity, a single member LLC that is disregarded for income tax purposes. It may be disregarded for income tax purposes, but it is regarded for this purpose. If you have a single member LLC as a partner, that throws you out. You're not eligible. The estate of an individual other than a deceased partner. So you can't just have an estate that buys a partnership interest and then that makes them eligible. No, it had to have received it from the deceased partner. And you can't have a nominee. You might want to avoid a revocable trust. We'll talk in a moment about whether you need to elect out. I don't know whether I want to go to a lot of lengths. But if you do decide to go to lengths, you could avoid a revocable trust by considering non-joint tenancy, a non-probate transfer like a beneficiary designation, or a transfer via a partnership agreement if that is permitted by applicable state law. Another idea is that if you have an irrevocable trust, it can contribute the partnership interest to an S corporation. So the S corporation is opaque as to the type of shareholder, but not the number of shareholders. So what does that mean? So let's suppose you have an S corporation. Suppose you have a bunch of ineligible shareholders. they can all form an S Corp. And so now you don't have an ineligible shareholder because the S Corp is an eligible shareholder. But if you had like 10 of these shareholders, okay, then those 10 shareholders are considered to be statement recipients. And so you would count the K1 that goes to the S Corp and likewise the people who would be affected by the S Corp's items being adjusted. So if you had 10 shareholders in the S Corp, then you'd have 10 statements there. So S Corps may complicate trust termination. So I'm not really thrilled about this idea. There may be some other income tax reasons why an irrevocable trust might want to use an S corporation. In fact, we'll touch a little bit on those in the second segment. If you are eligible to elect out, you can do it. It's an annual election on the partnership return, so each year you would need to separately do it. You have to provide certain information as listed on the slide. You have to promise that each partner is eligible and provide whatever else IRS wants. Do you really want to elect out? So we saw a situation where the client had like a $25,000 adjustment on his partnership return, and the IRS went to implement that on his return, and the IRS noticed that he had a huge S corporation loss, and it turned out that the S corporation actually had never made its S election, and so he was not able to take that S corporation loss, and the IRS disallowed that loss, and disallowed like an $800,000 loss. So that person wound up having huge consequences to having had his prior return looked at. If these rules had been in effect then the partnership would have just paid the tax, and his individual return never would have been subjected to that audit, and that would have saved him a lot of money. So you might not want to elect out. You don't want to necessarily amend each partner's federal and state returns. Think about what your audit risk is. I mean, if it's just really small, nitpicky items, then do you really want to have to amend everybody's return? Maybe you're better off having the procedure and having the partnership pay the tax and move on if there's an audit. And if you have lots of state returns that go along with it, again, it might be better to just pay the tax and not make all the different partners. Like if you have 50 partners and they have do business in 40 states, so you've got 2,000 returns that have to be amended. It may be better to just not elect out and just let the partner pay the tax. Let the partnership pay the tax, and partnership pay it at the federal and any state level. And if you do elect out, by the way, the IRS is checking to see whether you're eligible to elect out. So I don't know whether electing out is really going to reduce your risk of audit or not, because they did say they are going to check out to see whether people are eligible to elect out. The partnership audit rules basically, overall, I really think that they will generally provide a fair result. I mean, unfortunately, they will result in a lot more audits than before. But if we really want to be objective about it, the government was not auditing enough returns, and it wasn't, if you look at all the statistics, and from a fair tax policy, generally this is going to be a fair tax policy with fair results. So I did think at first, when people were first reporting on it, that this was going to be a horrible thing, but now that I've looked at them some more, I really do think that generally it is going to be a fair result. Again, I don't think that you're going to want to amend partnership agreements now, because the IRS is still issuing regulations, and as people look at those regulations and notices and whatever else they send out, they will be developing sample forms, and then, so see what everybody develops, and then pick and choose, but let everybody else do the work first. Don't be the guinea pig yourself. Let other people do the work, and then when you've seen, go to another CLE in another 6 months or 9 months or whatever, and figure out from there what are the best practices that have evolved. Then figure out what you want to do for your clients, and then amend the partnership agreements. Because really, anything that you do by March 15th, 2019 is going to have a retroactive effect on the partnership. So you've got plenty of time to do it. Now, if there's a sale going on right now, a 2018 sale, and then the partnership representative can have some influence on the results of that sale, then you might want to have a provision in there. Like, for example, if you know that the partnership was not going to be able to elect out, and if we know that the partnership didn't want to ever do the push-out election or whatever because it doesn't want to have impact everybody's returns, all these multiple returns, it was just going to pay the tax anyway. So if the partnership was just planning on paying the tax anyway, then you need to think, well, if the seller is no longer in the partnership, but the partnership is paying the tax, where's it going to get the money to pay the tax? The seller should have paid that, but the seller's not around anymore. So do you need to have some kind of a tax escrow? Now, this is not a horrible issue to worry about in terms of being a new issue, in that if you had a C corporation and somebody's selling stock in their C corporation, you had the same issue. The C corp was always at risk for prior year taxes. And so this is not a new issue in corporate transactions. It's just new that needs to be applied at the partnership level. We have the code word, which is audit. So audit is your first code word. Okay, so I'm going to talk about trust and the new 20% deduction for pass-throughs. I'm going to do a very brief overview of the new deduction. I did one in my fourth quarter 2017 webinar that was on January 30th. And so if you want to get a little bit more details on the 20% deduction, you can go to that. I'm just going to do a really brief overview of it. And it's just the important ideas so that you can see how those important ideas would apply to trusts. And then we're going to talk about, if you are putting a business entity in a trust, what other tax complications does that cost? And then I will talk about the 2017 reform and tax reform and how those affect trusts. So I'll spend a little bit of time on that. The 2017 tax reform repealed the old deduction for domestic production activities, and it applies from 2018 to 2025, and applies to the trust that owns a partnership interest, S corp stock, or maybe does business on its own. Maybe it has a single member LLC. And the deduction is up to 20% of the qualified business income. And again, I'm not going to get into that calculation right now. Some businesses are not allowed to get the deduction unless their taxable income is below certain thresholds. I'm going to talk about those thresholds in a moment. So you can see here the list of specified service businesses, basically any service business, health law, et cetera. Now, the original list included engineering and architecture as these disfavored businesses. But the real estate lobby got in and said, let's give our engineers and architects a break, give them a tax break. Maybe they'll pass that on to us and give us lower costs in our development, I guess. Because we know the engineers and architects wouldn't want to try to maximize their revenues. They always want to share any savings they get with their real estate development buddies. So I'm being facetious about that. But really the bottom line is that like we lawyers and accountants and financial service providers, we are all just scum of the earth, and engineers and architects are doing God's work, and so they're more deserving. So anyway, if your taxable income is below certain thresholds, then you don't have to worry about being blacklisted. It's only if you're above the thresholds. And we're going to talk about the benefit of trust in trying to be able to qualify your income to get that deduction. Some additional specified service businesses, basically like, broker dealers, day traders, stuff like that, those also do not get the deduction unless their taxable income is below the threshold. Items must be effectively connected with U.S. trade or business. There are really two different elements of that. One of them is it needs to be a U.S. trade or business. The other is, and I'm not sure how much Congress was really trying to delineate for that, whether it was really just trying to make it domestic, or whether it was also trying to delineate the scope of the business. It was incorporating by reference this foreign tax credit, this foreign tax idea called the effectively connected income. But if you look at the literal language of the statute, what it says is that the assets must be currently used in the active business. If you have some assets that you bought but you haven't started using them yet, then you don't get to count them. And we're going to talk about that in a little bit later. If I remember, yeah, if I put something in here later, we'll talk about that a little bit later about the significance of that. The sale of a partnership interest would itself, you're going to look at the underlying assets to see whether that would qualify. Sale of S Corp stock would not qualify generally to get the 20% deduction, but there are certain elections you can make to treat the sale of your S stock as instead a sale of S Corp's assets followed by a liquidation of the S Corp. And in that case, the sale of the assets might generate qualified business income. You'll see that there are some items that are not to be taken into account. Originally, the statute said investment items not to be taken into account in doing the 20% deduction, but the Appropriations Act in March of 2018 removed the word investments from that. So now it's pretty clear that any capital gain or loss is not going to be eligible for the 20% deduction, even if it's a business asset. Only if you had an ordinary income component. So that would be like if you had sold the partnership's assets and they were depreciation recapture, that would be taxed as ordinary income. That ordinary income component to the sale of your partnership interest would be eligible for the 20% deduction. Likewise, if you did your S Corp and you had that election to have a deemed sale of the S Corp's assets, then the depreciation recapture would be eligible for that 20% deduction. The deduction is really the lesser of the 20% of the business income or a wage limitation. And that wage limitation does not apply when the taxable income is below certain thresholds. So the wage limitation for each separate trade or business, you get to choose what you use. Each year you get to choose it. The individual taxpayer gets to choose it. 50% of the W-2 wages with respect to the business, or the sum of 25% of the W-2 wages plus 2.5% of the original cost of depreciable property while you're still in the process of, basically while it's during its class life. So this wage limitation can reduce your deduction. And I mentioned on the prior slide that if your taxable income is below thresholds, then that wage limitation does not apply. And here's the taxable income threshold. For married filing jointly, if your taxable income, and that's taxable income, that's not your business income, that's your taxable income, after you count all of your business and non-business income and non-business deductions. Okay, so all of that stuff is counted. Standard deduction, if you take that, that's counted. So if a married filing jointly couple has taxable income of no more than $315,000, then they get to take the deduction even if they have a disfavored business. And they get to take the full deduction even if the wage limitation would have reduced it. Now, if they're above the 415, then that disallowance of the disfavored business totally wipes out the deduction. If they're not disallowed by being a bad business, an evil business like mine, then the wage limitations would apply in full force. And between the 315 and 415, there's a prorated application of those ideas. Now, for everybody else, other than married filing jointly, the thresholds are 157.5 to 207.5. So here's the key with trusts is that if we really could use these thresholds and get a benefit from it, we might want to shift income. We might want to shift income to trusts. And then that way we can split it up. So let's suppose that we had a hairy entrepreneur, and hairy entrepreneur has a very profitable partnership, and hairy entrepreneur decides that he doesn't want to have to pay as much taxes on the partnership, and he would like to take advantage of the taxable income thresholds. Well, he might want to make a gift of some of his partnership interest to his kids, or maybe to trust for his kids. And of course, as an estate planner, I always want to put things in trust because I like to help protect the wealth for the family. So let's explore the trust some more. So what are the rules for trusts? So first of all, Code Section 199A said that you look into the trust rules for old Code Section 199. So you look at the rules from that to inform you on how the rules would apply for the 20% deduction here. So what I did in my materials, that again, this is all my newsletter, and in my materials, we have a detailed reproduction of those particular regulations from Code Section 199 and an interpretation of how those would apply to trusts. So I'm very confident in my interpretation of this, but of course, the IRS can always come out with whatever the heck it wants to come out with. We'll see. And I mean, obviously it has to be within reason, but the IRS might come out with a different approach than what I do. So all I can say is that if we don't get any guidance at all, I would feel very comfortable using my ideas in planning and in reporting things on tax returns. But it's always possible that we'll get guidance that will contradict what I'm saying here. So you'll always want to look when that guidance actually comes out. So if you apply those rules, first of all, grantor trusts are disregarded. So grantor trusts are trusts that are where there's somebody who's the deemed owner of the trust, and they report all the trust tax attributes. So you might have an irrevocable grantor trust where the person who created the trust is taxed on it, or you might have a trust where the beneficiary is the deemed owner of the trust. So those trusts are disregarded. So the K-1 items, when the trust gets its K-1, it just hands that K-1 over to the deemed owner, and the deemed owner simply reports those items. Now, let's suppose you have a non-grantor trust. So you know in a non-grantor trust, what happens is that there's a hybrid taxation going on here. The trust is taxed on its income except to the extent that it distributes the income to the beneficiaries. Now, what you do is you do a calculation on how much income could be, taxable income, could be distributed to the beneficiaries. And that, not necessarily under the trust instrument, but if the trust agreement lets you distribute the whole thing to the beneficiaries, what would be the amount that possibly could go to them? That's called distributable net income. And so what happens is that when the trust makes a distribution to beneficiaries, it will deduct that distribution up to the amount of their share of this distributable net income, or D&I. That's the general tax rule. And so, like, suppose you had a trust and it had $300,000 of income, and suppose that partnership distributed them $300,000 to the trust, and the trust distributed $150,000 to the beneficiary. So if it has $300,000 of D&I, which is basically the K-1 income, and it distributes $150,000 to the beneficiary, that trust is going to get $150,000 deduction and is only going to be taxed on the remaining $150,000. So that's the normal way you have trust income taxation. So what happens with these tax attributes? So remember, with this deduction, we have the qualified business income we need to consider. We have the wage limitation, so we need to consider wages. And there's this one component of the wage limitation was the original cost of depreciable property. So we have that. So we have the business income, the wages, and the property. So those tax attributes, the trust will share those with the beneficiaries. So if the trust distributes half of its D&I out to the beneficiaries, then the beneficiaries will receive half of the qualified business income on the K-1. The K-1 will report half of the wages and will report half of the qualified property. Then the beneficiaries will apply the beneficiary's taxable income. That will be plugged in with your business income and the wages and the property, and so that will be applied at the beneficiary level. And then the trust, again, it only has half of these items left. Trust has $150,000 of taxable income. I'm just rounding up. I'm ignoring exemptions. The trust has roughly $150,000 of taxable income. Before the deduction, it was all qualified business income. So that is below the 157.5 threshold. So the trust will just simply be able to deduct 20% of the $150,000. It'll get a $30,000 deduction. So even though the trust got a K-1 from the partnership of $300,000, and that's over the 157 threshold, the trust taxable income was below the threshold, and so you got the full benefit of the deduction, and you didn't have to count whether it was an evil business or whether they didn't have enough wages or property. So what if you have an S corporation and you have an irrevocable trust? It's an S corporation. It's like you have a non-grantor trust. It's an S corp. There's two different ways that a non-grantor trust is allowed to hold S corporation stock. There are some transition things when you first get the stock in certain circumstances, but once you get that, the kind of long-term holding, you need to either make an electing small business trust election, or, as it says ESBT there on the slide, or a qualified subchapter S trust election, QSST. So how do those work? The electing small business trust, the code and regulations basically say that the S corporation items are considered to be almost like their own separate trust. So if you have a trust that has S corp stock and it has a portfolio of marketable securities, the S corp stock, its taxation is calculated based as if it were its own standalone trust. And then the marketable securities portfolio, its taxes are calculated as if it were own separate trust. Now you put both of those on one trust income tax return, okay, but you're doing two separate sets of calculations. So I think that what you're going to be doing here is you're going to look to see whether the ESBT portion has 157.5 of taxable income or not. Okay? You're not going to look to what the marketable securities portfolio does. You could have $10 million of income under the marketable securities portfolio, and that should not affect your ability to get the deduction at the ESBT level because the ESBT level is isolated. I think that that is the best way to read the rules, but again, we don't have guidance from the IRS, so I could be wrong. Who knows what they're going to do? Another option could be, let's suppose you had a partnership interest and the trust contributed a portion of the partnership interest to an S corporation that the trust owned. And then the trust makes an ESBT election. So I think that the correct interpretation of that is that the partnership K1 that flows into the S corporation will have all the levels applied at the ESBT level for that portion, and that the balance of the partnership income, which the trust receives directly and not through the S corp, that will have the taxable income limitations separately applied to that. I think that that is the correct interpretation of the ESBT rules and how this would generally apply based on the old 199 rules. I think that's right. Now, the IRS might decide it doesn't like that because you have one trust that's getting two separate thresholds for the same business. So I don't know if the IRS will decide it doesn't like that or not. I would like to get clarification so we know one way or another. Now, qualified subchapter S trust, a QSST. So those, the beneficiary elects to be taxed on all of the S Corp's K1 income, and so that is a deemed grantor trust as to the beneficiary, and so that simply passes along the K1 items to the beneficiary to calculate the beneficiary level. Suppose you put the pass-through income in a trust, what kind of complications arise? One is the 3.8% tax on net investment income applies if you have passive business income. To be non-passive, the IRS's interpretation is that the trustee of the non-grantor trust must participate in the business in the trustee's capacity as the trustee. And that is complicated. And there's been litigation over it. The IRS has not really fared very well in litigation, but it is an item that does get audited. And you'll see my materials go into that in more detail. So I don't really have time to cover it on this webinar. That alone would take a good 15, 20 minutes. If the trust is a QSST, again, you would be looking to the beneficiary's participation because they're the named owner. But if you sell the business, then the IRS's position is that you would have to look to the trustee's participation at that time. This doesn't make any sense at all as a practical sense, because if the trust was disregarded and the trustee is deemed to have, if the sale is just a nanosecond of time in which the trust is considered to be a separate entity, how can you say there's been trustee participation? Why would you need a test for that? That doesn't make any sense because it's supposed to be participation over the long run. So I don't really like the IRS's rule, but the idea is that if you do have a QSST, consider having the trustee participate sufficiently to be able to avoid the net investment income tax on the sale of the business. So notwithstanding the fact that on an annual basis, all you really have to look at is beneficiary's participation, getting the trustee to participate can save you tax if there's a sale of the business and you don't have enough time to plan for it. Depreciation. Trust cannot use Code Section 179 depreciation, which is an expensing provision, but they can use bonus depreciation. And bonus depreciation was something that came around in the past several years as a something to stimulate the economy. Like they would say, we'll let you write off like 30% right up front, no matter how much you're investing. The Code Section 179 had a limitation to it. The bonus depreciation didn't, but Code Section 179 was allowing you to expense the whole thing, whereas bonus depreciation was only a fraction, like 30% or something like that. Well, 2017 tax reform lets you have bonus depreciation up to 100%, and for any property that has a life of no more than 20 years. So trust can use the bonus depreciation, but the other unusual thing about depreciation is that if the trust does not maintain a reserve for depreciation, then the beneficiaries deduct the depreciation directly as a separate K-1 item. Now, this is contrary to what anybody would have thought when you do normal trust income taxation, because normally you flow through only income to the beneficiaries. You never flow through losses or deductions. It's only the net income. But there are actually special trust rules in Part 2J11 that talk about the fact that beneficiaries can deduct depreciation directly. I did have a question here. Does old Code Section 199 come back in 2026? And I don't know the answer to that. My gut reaction is that it does not, but I do not know the answer. Okay, let's go. So I've just discussed enough about the qualified business income. A few more side notes on trusts. So administrative expenses are fully deductible. There are some items that they're deductible for trust as administrative expenses, but if an individual had them, they would not be deductible at all because they'd be miscellaneous itemized deductions. So this, again, would be another webinar in itself, but I just wanted to point out that that you want to look at the things that are unique to a trust, and those get to be deducted at the trust level. And the fact that you have your K-1 going to a trust might help, and that you might be able to get some deductions you might not otherwise have been able to. The state tax deduction, here's a big one. An individual can deduct only up to $10,000 of the cumulative state income tax and real estate tax. Now the real estate tax, there's no limit if it's business real estate tax, but there is a limit if it's personal real estate tax. But the state income tax, it doesn't matter whether it's business or personal, the $10,000 limit applies to all of it. If you deflect some money to a trust, then the trust will have its own state income tax burden, and it will have its own $10,000 threshold. So by using trusts, you can have multiple $10,000 thresholds by diverting the income to the trust. Now, there's a multiple trust rule I mentioned at the bottom of the page. The multiple trust rule basically says if you have abusive trusts, then you can only count them as one trust instead of multiple trusts. Now, if you have a separate trust for each beneficiary, I have no doubt that that would work. But if you have like 10 trusts for one beneficiary, I think the IRS would view that as abusive and say you just have one trust. Now, there may be reasons to have more than one trust for a beneficiary, and so you should document those. Now, there is an argument that because the IRS has not promulgated regulations on this. The IRS does not get to apply this rule. So there's a possible argument about that, but I wouldn't count on winning that argument. But it could be a matter of, you know, nothing ventured, nothing gained. So that's up to you. So trust is our last code word. Second code word. I'm going to talk about the fact that investment management fees are not deductible anymore. There's an alternative way to pay for the investment management, and we'll also talk about C Corps holding investments. Miscellaneous itemized deductions are disallowed totally before 2026. Now, a lot of people would not have gotten the deductions anyway because alternative minimum tax would have disallowed them. So the strategy that I'm about to talk about is something that you want to consider if you have, I think, more than $50,000 in management fees that you're paying. And you want to consider it now, but you'll also, it would still be beneficial after 2025 because AMT might have disallowed your deduction. So this is something that people might have considered doing all along. There was actually a family that has been doing this all along, and that is the family. Those of you who might have known Linder Bagels in your frozen section, your freezer in the grocery store, so Linder Bagels, well, those guys created a management company, and that management company managed 3 different investment partnerships. One investment partnership had private equities, one had hedge funds, and another had public equities. And what happened is there's a guy named Keith Linder, and he was actually managing the investments for the other side of the family. And so what happened is that rather than there's this Linder Management LLC that was the management company, and rather than paying just a flat fee to Linder Management for services, a chunk of the compensation was a profits interest for the services. And so what they did is, instead of paying the fee, they shifted income to the investment management company. So if you think about that, now the investment manager was picking up the income, which the investment manager would have done anyway if it had received a fee. But because we are deflecting partnership income to that investment manager, basically the original partnerships that were the 3 investment partnerships, they were not paying taxes on that income because that income was going over to the investment manager. So instead of having a potentially disallowed investment management deduction, instead of that, they shifted the income to the investment manager. So that was all well and good. The IRS accepted that. What the IRS didn't like is that the investment management company deducted investment management fees. Here's the arrangement they did. The compensation was a percentage of assets under management, but it was capped at the profits. It also got a little bit of extra kicker for some of the if the assets did very well. So a key thing that the court found here was that Linder Management operated for the purpose of earning a profit. So this Keith Linder who ran the business wanted to earn as much money as he could. He wasn't trying to give a break to his cousins or whatever, to the other side of the family. He wanted to make money. He wanted to serve them well, but he wanted to make money doing it. Linder Management had 5 employees. Keith Linder worked 50 hours a week. He was very active, very well qualified, very professional with everything that he did. Because it was a family business. The IRS subjected the arrangement to heightened scrutiny, and the tax court did too. So they were all family members. But what the tax court found was, again, that even though Keith Linder was helping out his family, he also wanted to help himself, and he may, for whatever feelings he might have found for them, he wanted to get a fair, in fact, a lucrative return on his work. So the other thing is that there was no requirement or understanding among the members of the Linder family that they would continue to use Linder Management LLC. So even though Linder Management LLC had a profits interest, they could get kicked out, and somebody else could come in to be the investment manager and get that profits interest. So it wasn't necessarily a cozy arrangement or a locked-in estate plan type of arrangement. The investment choices and related activity were driven by the client needs. Keith would meet with all the different family members who basically had an interest in these three different investment LLCs, and he would talk to them and do what they wanted. They could withdraw their investments if they didn't like the management company services. Each of them had outside income, so they weren't dependent on this income. They viewed this as an investment, and so it was just the cold hard investment. And then, in terms of not having family collusion, Keith's cousins and whatever, they were all over the place, geographically dispersed. Some of them didn't even know each other. In fact, some of the family members hated each other, and they refused to attend the same business meetings. So he would have to have separate meetings with some other people. So it was very businesslike. They did have to overcome a pretty high burden. Back in 1941, the U.S. Supreme Court ruled that no matter how large the estate or how hard you work, day in and day out, it doesn't matter. If you're managing your own portfolio of investments, that is not a trade or business. And so you can't deduct investment management fees as a trade or business. And so Congress enacted Code Section 212 to allow individuals to deduct investment management fees. And the Whipple case, which was a U.S. Supreme Court case, acknowledged that that's why the Code Section 212 was enacted. And Code Section 212, of course, is what Congress just essentially repealed for individuals for their investments. So Congress giveth, Code Section 212, and Congress taketh away for 7 years. So then there was a case where this Beals versus Commissioner, and the guy managed investments for himself, for his wife, his 3 kids. When he was overseas, he would get telegrams to work hard. So he worked very businesslike, very full time, but since that was for himself and his kids, he did that without compensation. That did not count as a trade or business. If he did day trading, that would be a trade or business. But it's really short-term trading, and so those are the considerations. And whether you're a trader or not, trader versus investment, and slide 45 kind of goes into that a little bit more. But the bottom line, and so go into slide 46. So a dealer deals in property primarily for the sale of customers. So that's kind of self-employment income, whereas a day trader may be somebody who can get investment relief for it, investment income treatment, and not self-employment income. And a taxpayer can be a dealer to some securities and traders to others. So Lender Management LLC, when it paid the investment management fees, if it were managing its own investments, it would not be allowed to deduct those management fees, okay? Because we already had the U.S. Supreme Court tell us you can't deduct investment management fees as a business item. And the whole question was whether this would be allowable as a business item. They wanted it to get a Code Section 162 deduction because we know that the miscellaneous itemized deductions are not nearly as good as a business deduction. So they wanted to count this as a business deduction for the LLC. So Lender Management LLC did invest in some of those investment LLCs, but it was a relatively small amount. The lion's share of what Lender Management got as its return from those various things was profits in exchange for services. And the relationship between the management company and the investment LLCs was a business relationship. So the court allowed Lender Management to take a Code Section 162 deduction, the full benefit of any deduction, and for its investment management expenses. So that family got away with not having to worry about having what in today's environment would be a disallowed deduction. You could kind of do something like the lender deal, and you might have a base income. So, you know, if somebody's going to form their investment management company, they'd like to have a stable base. So you might have a target fee, and that target fee, again, would be capped at the annual profits from just ordinary investments, just from like the interest and dividends and stuff like that. And then on the gain and loss from the sale of investments, since those are not predictable, you would have a separate sharing of those, and those would be kind of like the bonus for excellent performance. So your performance bonus would be kind of through a sharing of your gain and loss on the sale of investments. Now, if the investment, normally I like the idea that they should be able to kick them out. You should be able to kick out the investment manager. But let's suppose you do kick them out, and then you have to buy out the investment manager. Would they get a capital gain on their sale? And most likely they're going to have a 3-year holding period. The normal holding period is more than 1 year, but for what they call carried interests, the 2017 tax reform made it be more than 3 years. So that particular provision doesn't apply to all partnerships, doesn't apply to all carried interest, but there's a good chance it would apply to this one. So you'd want to look at that. Lender Management was an LLC, and that's really, I think, why it got audited, because it was an LLC taxed as a partnership. So the individuals were essentially deducting investment management expenses. Instead of as itemized deductions, they got to take it off the top against their income. And that's really why I think they got audited. Another alternative, instead of having an investment manager being an LLC, have it be an entity taxed as a C corporation. And so there's actually, I think you have a better shot at getting the deduction for investment management expenses. And that's because Revenue Ruling 78-195 listed there allows a C corporation to take a Code Section 162 trade or business deduction for expenses related to investment property. So there's a different standard for C corps than for individuals. If it's an individual, you don't get to take a 162 deduction generally, unless you're like a day trader or a dealer. You don't get to take the deduction. You have to you're relegated to Code Section 212. Code Section 212 expressly applies only to individuals. And my understanding from somebody who has some background on this is that it applies to only to individuals because Congress assumed that a C Corp did not need it. And that's because of Revenue Ruling 78-195 and similar cases on which that revenue ruling is based. So I think that the C Corp is going to have an easier time deducting these fees and might not even draw an audit the way that the Lender Management LLC drew an audit. Even if the C Corporation can't deduct it, the C Corporation's income will be taxed at a lower rate. Normally, if you have a qualified dividend, your federal rate is going to be the 20% capital gain rate and 3.8% net investment income tax for a total rate of 23.8% if you're an individual. If you're a C Corporation, you've got a 20% maximum federal income tax rate, but dividends from domestic corporations get a 50% dividends received deduction, which generally applies for federal and state income tax purposes. So a qualified dividend that a C Corp receives would get taxed at a federal rate of 10.5%. That's 50% of 21%. So they get taxed at 10.5% instead of the individual's 23.8%. Taxable income. So what if you had taxable interest income, or if you had non-qualified dividends or short-term capital gains? At an individual rate, you've got the 37% top bracket plus 3.8% net investment income tax for 40.8%. Individual would be taxed at 40.8%. But if you're inside a C Corp, that's only a 21% federal rate. So you've got a much, much lower rate being inside the C Corp. So I'm going to talk in a minute about what happens if a C Corp accumulates investment income. But remember, if we have a family office that's receiving this income, you might set it up so that the family office is generating a modest profit. So there's no significant accumulation. So if there's no significant accumulation, then what you're doing is you're just saving income tax on these on this investment income. Either you're saving all of it because you've got all the deductions against it, or you're just saving with a lower rate, as I described on slide 50. So in a minute, I am going to talk about if you do have investments that accumulate inside the C Corp, but I just want to give you that backdrop. And the other thing is, when you have the family office, you need to consider securities law restrictions on managing others' financial assets. Now, since I did my newsletter, I have since put some securities law considerations into my materials. If you email me, you can find out about the securities exemption for family offices. But that's just me as a novice doing this. I just, my securities law partners show me the code and regulations on that particular exemption, and so I just have a summary of it. So it's not worth a whole lot because it's just I'm a novice at securities. But if you want to look at it as a good starting point to do your research, that would be a good place to look. To the next slide. So the code word is management, because we were talking about deducting investment management fees. If you have all these wonderful tax rates inside a C Corp, should you just have all your investments inside the C Corp? Well, one of the issues is, of course, Congress can always take away the 21% rate and reinstate a higher rate. And remember, this was the 2017 tax reform was passed on a partisan basis that increased the budget deficit by $1.5 trillion tax cut. I mean, supposedly the economic growth is going to come from it will reduce that cost to $1 trillion. But the bottom line is that this is a partisan basis budget busting thing, And so we don't know whether this 21% rate is going to stick or not. It's permanent, but the next Congress can make it unpermanent. So a C corporation can't accumulate dividends forever. If it has, once it has a certain amount of investment income, it's got a personal holding company tax. And if to the extent it accumulates as personal holding company income, there's a 20% supplemental tax on that. There's the regular tax plus a 20%. So that would not be a good deal that pay the personal holding company tax. Also, if you're, to the extent you're not a personal holding company, there's a possibility for accumulated earnings tax. And if you're just basically an investment type of entity, then you really can only accumulate $125,000 of reinvested profits before you start having to pay an accumulated earnings tax. And both the personal holding company tax and accumulated earnings tax are avoided by paying dividends. But of course, if you're paying dividends, now you have another layer of tax on top of it. So that's not a good deal. You could, after a while, convert your C Corp to an S Corp and then distribute the current taxable earnings, but you wouldn't be able to accumulate distribute the accumulated earnings without paying a dividend tax. There's passive investment income that people need to worry about. My materials talk about how to avoid that. And a corporation that holds just investments, it's really almost impossible to divide it. So if you have your family investments inside the corp and then C Corp and people want to go their way, it's really hard to divide it. So you might want to do some advanced planning for that if you are going to do a corporation, and my materials go into that advanced planning. You know, the definition of a tax advisor is somebody who explains a tax problem you didn't know you had in a way that you don't understand. I hope you've been able to follow this. For those who have interest in fiduciary income tax, you can click on the link to an hour-long fiduciary income tax refresher. My second quarter newsletter that will come out hopefully at the end of June, or maybe the beginning of July, we'll see. I'll have a webinar on that on July 31st. I encourage people to sign up for my blog or some other reports I have. So I hope you've enjoyed this, and I didn't really have any other questions that popped up, but you're certainly welcome to contact me afterwards. Until next quarter, look, I'll talk to you then if you don't contact me before. Have a good rest of the day.